Hello everybody, welcome to JAIIB CAIIB English Medium channel. I hope that all of you are doing fine. Today in this Hero to Superhero series, we will be talking about some good quality MCQs and through them we will be learning certain concepts for Indian economy and Indian financial system. So let's get started. First question in front of you, consider the following statements with reference to the government securities known as the G-SECs. The first statement states these are sovereign or the credit risk free coupon bearing instruments. So whether the risk is not involved in these types of instruments or not. These securities have a fixed coupon that is paid on specific dates. That's true. But on annual basis or some other basis is there, what will be the right answer? These are issued by RBI on behalf of Government of India in lieu of government's market borrowing program. So that is also correct. So one is correct. Third is also right. What about the second one? Anybody who wants to share their opinion, whether it is on annual basis or some other time period has been suggested under the government securities setup. So it is half yearly. Correct answer will be option A, 1 and 3 only. Fine. So do remember that these are the sovereign owned specifically by the government credit risk free coupon bearing instruments. So these are the sovereign credit risk free coupon bearing instruments which are issued by the RBI on behalf of Government of India in lieu or for that matter in return. Okay, lieu means what? Just the another synonym for return of the central government's market borrowing program. Then we talk about these securities. They have fixed coupon that is paid on specific dates on a half yearly basis, but not only half yearly. We have a wide range of maturity dates, like some are for the short term, that is less than 1 year, and long term till 40 years as well. Try to solve this question, which is based on SCSB, your self certified syndicate bank, which is again very important. When I talk about the SCSB, mostly the question revolves around the fact that whether ASPA service is involved or not. But this question states that self-certified syndicate bank is a bank which is specialized as a bank capable of providing application supported by blocked amount. So ASPA, that is the full form of ASPA only, ASPA services to its customers. Name of such banks would appear in the list available on the website of what? Whether it is SEBI, RBI, NSE, or the respective issuing company. So I just told you that mostly the question revolves around this fact only, whether the SBA services are provided by the SCSBs or not. So here it is mentioned itself. The next question, which the most probable question, which can be asked is, where do we find the list of such banks? So it is available on the website of not RBI but SEBI, that is Securities and Exchange Board of India. So A will be the right answer here. Explanation, you can see that SCSB is a bank which is specialized as a bank capable of providing the ASBA services to its customers. Name of such banks would appear on the website of SEBI. Now, when I talk about the investors, they submit the ASBA forms, fine, that everybody knows. After filling the details like name of the applicant, the PAN number, DMAT account number, bid quantity, the bid price, other relevant details, by giving instruction to block the amount in their account, that will be provided by the investors only. But where? Only at the designated branches of the banks, which are acting as the SCSB or the self-certified syndicate bank. Next question, in 100% of net offer to public through voluntary book built issue, allotments to different categories of investors are required. When I talk about different categories of investors according to their proportion, they are mentioned here to be ensured in which of the following proportions. So first type of investor, retail individual investors, whether for them your voluntary book built issue allotment should be not less than 35% of the net offer to the public or some another amount is there. Qualified institutional buyers, QIBs, not less than 15% of the net offer to the public. So always remember, whenever such type of questions are there, you should read between the lines. Not less than means what? It is that 35% is the minimum amount. And here also not less than 15 means 15% is the minimum amount. But as we move towards this option, the non-institutional investors, NIIs, not more than 50%. So not more than means we are talking about the maximum amount here. Okay, so always read between the lines. In the actual exam also, when you are attempting some question, you should be able to decipher that what the examiner is trying to ask. So not more than 50% of the net offer to the public, 5% of which should go to the mutual fund. So all of you who have already studied the QIBs, they must be knowing that it is not 15%, but in fact it is 50% for the QIBs, and for NIIs it will be what, 15%. So these two options are wrong. So correct answer will be one only, that is option A. A will be the right answer here. So in a pricing of the issue, what all parameters we have to remember for our exam? See, the 100% of the net offer to the public through voluntary book built issue will be allotted to different categories of investors, and the proportion will be like this: 50, 15, and 35. 50% for your QIBs. NIIs will have a minimum of 15%, and RIIs will have a minimum of 35%. Next question related to the forward contracts between various parties like buyer and seller. You have to select the correct statement. So this question will tell you that no matter how hard the statements are, how hard the sentence is provided by the examiner, if you know the basics, you will be able to solve a particular question and gain at least 1 mark, because such type of questions will be asked for 1 mark. The first statement says the terms of contract, once finalized, cannot be tailored to suit the needs of any party, be it the buyer or the seller. So once the terms of contract are finalized, whether you can change the terms and conditions or not of any kind of contract, it is a contract which gives buyer or the holder the right but not the obligation to buy or sell specified quantity of the underlying assets at a specific or the strike price. So always remember, whenever we are trying to say that whether a strike price has been issued or not, this particular forward contract will involve a particular price or not. So yes, we must be having a particular price which will be paid off in a future date. But here it is not mentioned. It is saying that it is not an obligation. In the Indian context, it is mandatory for all the forward contract booking to be with a genuine underlying in the form of a firm order, letter of credit, or documentary bill. So the documentary bill, or for that matter LCs, whether they should be there or not in the Indian context when we are talking about the forward contract. For all the forward contract, mind it, the keywords are very important here. Neither party can walk away unilaterally from the contract. That is, both the parties are obliged to fill their contractual terms. This is the basic definition of your contract. Fine. We have the agreement, and once the agreement is legally enforceable, then we say that yes, we have the ultimate contract in the offering. So the correct answer for this question will be what? Obviously, option D will be the right answer, which is absolutely correct. The rest statements contradict the actual correct statements. So a forward contract, basically the forward foreign exchange contract, is the one that covers the transaction which is executed today at a rate agreed on today, but the settlement will be as per the agreed amount for the future date. The forward exchange rate is calculated as a combination of spot exchange rate and the interest rates over a period of time in the future only. A forward contract is an agreement where two parties agree to specify trade at a specified point in the future itself. And when I talk about the OTC, so yes, the contract is negotiated directly by the buyer and seller. It is an OTC agreement, fine, whenever it is directly negotiated between the buyer and the seller. And neither party can walk away unilaterally from the contract because it is legally enforceable. That is why D was the right answer. Next question talks about a simple numerical. Mr. Rajesh owns a restaurant which he bought 3 years ago for rupees 50 lakh. He had bought fire insurance worth rupees 40 lakh His restaurant caught fire and he suffered a loss of 50 lakh. Amount of compensation to be paid by the insurance company will be what? So when I talk about the principle of indemnity, there you will find that the insurance company will make good your losses. So whatever loss you have incurred, except for the life insurance, the clause of indemnity will work. And here, what all is provided? So the property which has been covered, the amount of that property, the value of the property here is 50 lakh. Then we have the fire insurance cover amount will be 40 lakh. Yes, it is not 50, it is 40 lakh. Here it will be the amount as 40 lakh. After that, we have what? Also, the loss amount is also given. The actual loss has been estimated to be 50 lakh. So simply we will be doing what? We will divide the coverage, the amount covered by the insurance company, by the value of property or the asset involved, and multiply it by the actual loss amount. So here the coverage amount will be what? 40 lakh divided by value of property, that is 50 lakh, multiplied by uh, the particular loss which has incurred by the individual or the entity, which is 50 lakh. So this 50 lakh will get cancelled and we will get the answer as 40 lakh. So B will be the right answer here. Okay. Fine. If you want to have an elaborate discussion around this particular principle of indemnity, you can definitely join our crash course where we have defined not only the principle of indemnity, but all the principles which are there in the insurance setup. Next question, match the following credit rating symbols correctly to the description provided below. So we have the description and against that we have the credit rating symbols. So double A is for what? When we talk about whether it is for the vulnerable to default category, high risk, high safety or moderate safety. So yes, it is for the high safety. So for double A, we will have 3 as the right answer. Triple B, whether it is for the high risk or vulnerable to default or moderate safety. Yes, this will be your moderate safety. So triple B will be moderately safe. Single B will be the high risk category. Okay, it will be the high risk category. After that, we have C, credit rating symbol, as the vulnerable to default category. So A 3, A3 is only one option. Then B we have 4, B4, C2, C2, D1, D1. So B will be the right answer here. Yes, B is the correct one. Okay, so try to solve the questions in a fixed, you can say, time frame within 30 seconds only. That should be the maximum time which you are spending on a particular question, be it a lengthy question or a mediocre question, because ultimately in the examination, you won't be able to solve 100 questions if you do not have the desired speed. Fine. So when I talk about the ratings, they are classified into 3 grades, starting off with the high investment, then investment and speculative grades. The 3 levels, all these 3 levels will be having different ratings. The symbols like triple A, double A, triple B, B, C, D you will find, and across this category you will have across this particular rating you will have 14 to 15 categories. Sign will also be utilized, plus or minus, as you know that the triple B minus is considered to be a better rating as compared to double B plus. So always remember the alphabets, the more the alphabets, the better the safety for a particular entity. Okay, that is why B will be the right answer. Next question, the commitment fee is payable to the forfeiting agency and it ranges between what? What is the range? The range has been asked whether it is per quarter, per annum, that you must know. Otherwise, if you don't know, then you will get confused between A and C. But here, the correct answer will be per annum, and C is the right range, 0.5 to 0.5 to 1.5% per annum. Okay, for forfeiting, you can see it ranges between 0.5 to 1.5 per annum. Last question, in the context of RBI Act 1934, select the correct statements from the following. So we have 4 statements. The RBI Act is divided into 9 chapters. In addition to the chapters, it has 5 schedules. In the year 1949, Government of India nationalized RBI with effect from 1949 January 1st under the RBI Transfer of Ownership Act 1948. So confusing statements, fine. After the partition of India, RBI ceased to supervise the banking system in Pakistan from 15th August 1947. So what is the right answer here? Surprisingly, the correct answer is option C. That is, we have the RBI nationalized under the Act of Transfer of Public Ownership 1948. Okay. So this was it for today's class. If you want the PDF of this session, you can directly scan this QR. And if you want to enroll in the courses which are being offered right now, you can directly contact us on the number 0981